You are welcome to Unit 3, Section 4. Our topic for discussion is withholding of tax and treatment of overtime, bonus, and benefit in kind payments. By the end of the session, you should be able to identify various income and state the rate of withholding tax applicable, and state the rate of tax applicable to overtime and bonus. We start with the pay as you earn. The system of withholding tax at source from salaries and allowances paid to employees is popularly known as pay as you earn, payee for short. Under this system, the employer is required to withhold tax at the rate specified in the first schedule, paragraph 1 of Act 896, and this is subject to amendment every year. To withhold simply means to deduct. The tax withheld is to be paid to the commissioner not later than the 15th day of the month following the month in which the deductions were made. The employer is also required to submit a return not later than the 31st March following the end of every year of assessment. This return shall be in the form prescribed by the Commissioner. A separate return is also required from each employer of the employee who receives assessable income for the year from the employment. Failure to withhold becomes the liability of the withholding agent, in this case the employer, but he may recover this amount from the payee. As explained earlier, withholding tax is a tax which is deducted at source by a withholding agent when making payments to another person and accounted for to the authority. In this session, we will restrict ourselves to withholding tax under employment income. Later, you can go to the GRA website to see a full list of income and their respective withholding taxes. Fees to resident individuals as invigilators, examiners, and part-time teachers or lecturers, and endorsement fee. The rate is 10% final tax. When we say a tax is a final tax, it means that the tax withheld satisfies the liability of the taxpayer and the income shall not be included in ascertaining his or her assessable income. Once you pay the tax, the gross amount is not supposed to be added to any other income for it to be taxed again. Fees or allowances to directors, managers, board members, trustees who are resident individuals. The rate is 20% and this is on account. It means that once you pay the tax, the gross income is added to your other income and taxed accordingly. After we get the tax liability, we are going to deduct the tax paid on that amount from it to get the net tax liability. Commission to insurance, sales, canvassing, and lotto agents who are individuals. This is also 10% on account. Let us look at withholding tax from overtime. When an employer pays overtime to any employee, that is not more than 50% of the employee's monthly basic salary, the employer will deduct 5% as overtime tax. However, if the overtime paid is more than 50% of the employee's monthly basic salary, the excess of the 50% is taxed at 10%. The overtime rate is applicable to employees who are junior staff. And according to our tax laws, a junior staff or junior employee is one with their qualifying employment income, including profit and gains for the year, is less than 18,000 Ghana cedis. For all other employees, overtime payments are included in employment income and taxed under the graduated rate. Let us note that for non-resident employment, let us note that for non-resident employees, their tax on overtime is 20%. In general, overtime tax is a final tax. Let us look at an example. During the year to 2022, Kofi Eje received an annual basic pay of 9,650 Ghana cedis. In addition, his overtime income amounted to 4,500 Ghana cedis, determine his tax liability on overtime. We first have to determine whether Kofi Eje is a junior staff or a senior employee. So to get his qualifying employment income, we have his basic pay plus other incomes, in this case, the overtime. So we have 9650 plus 4500. This is giving us an amount of 14,150, and this is less than 18,000. So this makes Kofi Eje a junior staff. Now let us look at the overtime. The overtime, so 4,500 of 9650 times 100 is 46.6%. The overtime forms less than 50% of the basic salary. It means that the whole 4,500 will be taxed at 5%. So tax on overtime, we have 5% times 4500 is equal to 225. Let us look at another way to solve this question. You can first determine the monthly basic salary, then the monthly overtime payment, find the percentage, and then you decide whether the full amount will be taxed at 5% or there's excess. So let's do that one here. So we have 9650 divided by 12, which gives us 804. And the monthly overtime, we have 4500 over 12. And this gives us 375. So 375 out of 804 times 100 gives us 46.6%. The overtime here is less than 50% of the monthly basic salary. So just like we did, we are going to tax it at 5%. We are going to get 225. Let us look at another example. Assume that all information in illustration 1 are same, except that his basic salary and overtime for the year were 9,650 and 4,900 respectively. Determine Kofi Eje's tax liability on overtime. So let us find the percentage of the overtime from the basic salary. So far, 4900 over 9650 times 100. This is giving us 51%. This is more than the 50% where it will be taxed at 5%. The excess is taxed at 10%. Okay. So first, we find 50% of basic salary. So 50% times 9650. This is going to give us 4825. And then the excess is going to be 4900 minus 4825. And this is going to give us 75. So now let us look at the computation of the tax. So we have first 4825 at 5%, and the amount is 241.25. Then we have the excess 75 Ghana cedis at 10%, and this is giving us 7.5. So the total overtime tax is 248.75. So from the amount of 4,900 given to him as overtime, he's supposed to pay 248.75 as tax. Let us look at another example. Assume that all the information in illustration 1 are the same, except that his basic salary and overtime were 20,000 and 2,500 respectively. Determine Kweku Eje's tax liability on overtime. Right from the basic salary, we have an amount of 20,000, which is more than 18,000. So it means that if we should even add the overtime of 2,500 to the 20,000 to get his qualifying employment income, we are going to get more, because right from the beginning his basic salary exceeds the threshold. So from this we can say that Kofi Eje is a senior employee. Kofi Eje is a senior employee because his qualifying employment income, which is 20,000 plus 2,500 equals to 22,500, is more than the threshold of 18,000. Thus, his overtime would be included in his employment income and taxed using the graduated tax schedule. Let us look at withholding tax from bonus. Total bonus payments made by employers to their employees in a year of assessment where it does not exceed 15% of the annual basic salary, it is taxed at 5%. Where the bonus payment exceeds 15% of the basic salary, the excess will be added to the employment income of the employee and taxed at the graduated rate. And this is irrespective of whether you were a junior employee and a senior employee. Please note that you can be a senior employee, but according to the tax laws, you will be a junior employee. Let us look at this example. During the year to December 2022, Kofi Eje received an annual basic pay of 9,600. In addition, his bonus amounted to 1,248. Determine his tax liability on bonus. Also, the tax on bonus is final tax. Okay, once you pay it, you don't have to add the income to your other income and be taxed accordingly. So let's find the percentage of the bonus from the basic pay. We have 1248 divided by 9600 times 100. It's giving us 13%. This is less than 15%. So it means that the whole amount of 1248 is taxed at 5%. So tax on bonus, we have Ghana cedis 1248 at 5%, and it's giving us 6240 Ghana cedis. Let us look at another example. Assume that all the information in illustration 4 are same except that his bonus was 4,500. Determine Kwekweje's liability on bonus. So the basic salary was 9600. So 4500 over 9600 times 100, it gives us 46.88%. This is more than 15%. So it means that the first 15%, which is the amount computed on his basic salary, will be subject to tax at 5%, and the difference will be added to other incomes and taxed accordingly. So let us look at how this will be done. So 15% of basic salary is 9600 times 15%. This gives us 1440. So this 1440 will be taxed at 5%. So tax on bonus, 1440 times 5%, and this gives us 72 cedis. Now the excess, which is 4500 minus 1440, 1440, we are going to get 3060. This will be added to his other incomes and be taxed accordingly. Let us look at benefits in kind or in cash. A benefit is described as an allowance paid in cash or given in kind to an employee by his employer. It includes a payment that directly or indirectly benefits that person. The Act 896 provides an amount, allowance, or benefit is a gain of profit from employment if it is 1. Provided by the employer, an associate of the employer, or a third party, either an arrangement with the employer or an associate of the employer. 2. Is provided to an employee or an associate of an employee. And 3. Is provided in respect of past, present, prospective employment. Let us note that these benefits are usually provided as incentives, salary supplements, fringe benefits, etc. Benefits in kind or in cash take several forms, and it includes direct daily, weekly, fortnightly, or monthly cash payment, accommodation, watchman, garden boy, cook, steward, etc. In respect to accommodation, there is a table we'll look at soon. Depending on the type of accommodation given to you, there's a particular rate that you're supposed to charge on the total cash emolument to get the rent element or to get the value of the rent or accommodation. In respect to watchman, garden boy, cook, steward, etc., we qualify these people or we classify these people as domestic servants. So we are going to look at how to we are going to look at the treatment for watchman, garden boy, cook, etc. When cash allowances is provided for any employment, irrespective of whether the building belongs to the employee or the employer, and the cash benefit is paid directly to the employee, the cash will be added to his salary to be taxed. If garden boy and watchman are provided to an employee and the building is for the employee and the company pays them, then the value of their salary is deemed to be the benefit the employee is enjoying. So we add it to his income and tax accordingly. So what this means is that their salaries are given to the employee to be given to them. But if it is not paid directly to the employee, it is not added to the salary as cash payment, but rather after rent and car element, so it does not increase the total cash emolument. We'll look at how this takes place when we solve a question. It is therefore treated as other non-cash benefit and therefore increases total accessible income. When the building is for the employer, then obviously the watchman, garden boy, steward, they are protecting the employer's property and not the employee. So he does not suffer a tax element. So the employee pays them directly. Now let us go to vehicle, driver, or both, fuel coupons, etc. With this one too, in our tax laws, depending on what you are giving, whether vehicle only, fuel only, car only, fuel and driver, fuel and car, there's a rate and this has a limit. We'll look at that also shortly. Then we have professional responsibility risk allowances, canteen subsidies, transport allowances, low interest loans or interest-free loans. Act 896 imposes tax on gains or profits from employment. It states categorically that the gains or profits from the employment chargeable under the Act include any allowances or benefits paid in kind or cash to or on behalf of that person from the employment. Benefits in cash. Unless specifically exempted, cash allowances and benefits are to be included in full in ascertaining the assessable income for tax purposes. Let us look at benefits in kind. The determination of the actual value of the benefits to be included in the chargeable income of the employee is not specifically provided in the law, regulations, or a schedule, will depend on a number of considerations. For example, defining the benefits to be assessed, valuation of the benefit, cost to the employer, value of the benefit to the employee, open market value of the benefit to the employee. Act 896, however, provides that the value of a benefit in kind is the open market value of the benefit on the date the benefit is taken into account for tax purposes. The open account value of the benefit is determined without regards to any restriction or transfer or to the fact that it is otherwise not convertible to cash. Basically, an employer is not responsible for provision of loans to its employees. However, as an incentive to employees, an employer may undertake the function of providing soft-term loans to its employees compared to what a free market may offer. So let us look at the conditions for quantifying loan. The loan is from the employer to employee. The term of the loan does not exceed 12 months. The aggregate amount of the loan and any similar loan outstanding at any time during the previous 12 months does not exceed 3 months basic salary. If any of these conditions is present, at least two of them is present, then we have to quantify the loan. The taxable loan benefit for any year of assessment is quantified as a quarter of the difference between the interest the employee pays and then the interest that would have been paid using the statutory rate applicable at the time the loan was taken. So we have interest at statutory rate minus interest at employer's rates. Okay, Let us look at an example. The table below shows the incomes of 3 employees of BB Company Limited: Shady, Judith, Israel. We have their basic salary to be 20,000, 30,000, 40,000 respectively. We also have housing allowance 2,000, 3,000, 4,000. Transport allowance 3,000, 4,500, 6,000. We also have clothing allowance 4,000, 6,000, 8,000. Their total cash emolument is 29,000 for Shady, 43,500 for Judith, and 58,000 for Israel. Besides the cash emolument stated, the employees receive loans from the employer as follows. Shady receives a loan of 1,400 at a rate of 12%, payable within 12 months. Judith received a loan of 14,000 at a rate of 12%, payable within 24 months. Israel received a loan of 8,500 at a rate of 12% within 16 months. The loan is in addition to an outstanding similar loan of 3,500 during the previous 12 months. Assume the statutory rate is 22% per annum. Determine the loan benefit applicable to the 3 employees. So we take the question again. From this table, we have our total cash emolument to be 29,000, 43,500, 58,000. Please take note of the basic salary because we are going to need it to determine whether the loan should be quantified or not. Shady received a loan of 4,400 at a rate of 12% within 12 months. Judith received a loan of 14,000 at a rate of 12% within 24 months. And for Israel, a loan of 8,500 at a rate of 12% payable within 16 months. This loan is in addition to an outstanding similar loan of 3,500 during the previous 12 months. Assume that the statutory rate is 22% per annum. Determine the loan benefit applicable to the 3 employees. So we'll start by looking at the conditions to see if they are present, and then we'll determine whether the loan should be quantified or not. Okay, so we were told that Shady received a loan of 1,400 at a rate of 12% payable within 12 months. Shady will not be liable to tax on loan benefits. Why? This is because his loan repayment does not exceed 12 months. He had no similar loan outstanding at any time during the 12 previous months, and the loan amount of 1,400 does not exceed his 3 months basic salary. So this is computed as 20,000 times 3 over 12, and this is giving us 5,000. Okay, so it means that Shady is not liable to pay tax on the loan benefit. That is all what this quantification is about. We want to know if you are liable to pay tax on the loan benefit, and even if you are liable, to what extent. Let us look at in the case of Judith. Judith will be liable to tax on loan benefit. Why? Because her repayment period exceeds 12 months. Her loan amount of 14,000 exceeds her 3 months basic salary. And together we have 30,000 multiplied 3 over 12. We have 7,500. Okay, so let us look at how to compute. Let us look at how to compute the interest payable at the statutory rate and then at the employer's rate. So we are going to use the simple interest formula, which is interest is equal to principal times rate times time. Okay, so we first find at the statutory rate. So interest at the statutory rate, which is 22%, we are going to get 14,000 multiplying 22% multiplying 2 years. We're told that her loan is payable within 24 months. We know changing months to years, 12 months gives us 1 year. So if we have 24 months, it means we have 2 years. We are going to get an interest of 6160. Then we have to find interest payable at the 12% rate. We have 14,000 times 22% times 12%, sorry, times 22. And we have an amount of 3360. We were told that the loan benefit is limited to 1/4 of the difference between the interest paid at the statutory rate and the one paid at the employer's rate. So let us find the difference between the interest payable. So the difference, we have 6160 minus 3360. This is giving us 20. This is giving us 2,800. So our loan benefit is 2,800. But then the limit of the taxable loan benefit is 1/4 of 2,800. So taxable loan benefit is limited to 1/4 of 2,800, and this is giving us 700. So out of the loan we received, only 700 is taxable. Let us look at in the case of Israel. Israel is liable to tax on loan benefits. In his case, his loan repayment exceeds 12 months. His current loan of 8,500 and any similar outstanding loan of 3,500 exceeds 12 months, exceeds 3 months basic salary. So we have 8,000 plus 3,500 is equal to 10,000, and this exceeds 3 months basic salary. Israel's salary was 40,000, so 40,000 times 3 over 12 is giving us 10,000. 8,500 plus 3,500 gives us 12,000. Okay, so now We will go through the same process as we did for Judith. So first compute the interest payable at the statutory rate. So we have 12,000 times 22% times 16 over 12, and that is giving us 3520. And then interest at 12% is giving us 12,000 times 12% times 16 over 12. This is giving us 1920. The 16 over 12, you can use 1 year, 4 over 12. Yes, 1 year, 4 over 12, because 1 year, 4 over 12. This gives us 12 plus 4 gives us 16. Okay. So now let's find the difference. 3520 minus 1920, and this is giving us 1600. So 1600 is our loan benefit. Okay, and then the taxable portion is limited to 1/4 of this. So taxable loan benefit is limited to 1/4 times 1600 is equal to 400. So only 400 is taxable. Okay, so Shady was not liable to tax on loan benefits or even loan benefits because his loan repayment period did not exceed 12 months and his loan amount did not exceed 3 months basic salary. He also had no similar outstanding loan. So here he had nil. Then for Judith, we said the limit was 700 and the loan term was 24 months. So every month she's going to pay 29.17. And then for Israel, we said it was 400 for 16 months and the monthly interest will be 25. So this 25 was gotten by 400 divided by 16. And for here we have 700 divided by 24. Okay, so for a particular year, which is 12 months in a year, we have to find the total interest to be included as loan benefit for tax purposes. So let us look at, we had a total cash emolument to be 29,000, 43,500 and 58,000 respectively. So loan benefit, Shady, we have nil. For Judith, we are going to multiply 29.17 times 12, and this will give us 350. And for Israel, 25 times 12 and this gives us 300. We are multiplying it by 12 because we are looking at the year interest or the year loan benefit, not for the entire loan term. Okay, so at the end of that year, total employment income in respect of Shady is 29,000, for Judith is 43850, for Israel it is 58350. So assuming they have no other benefits or no other cash allowances, these amounts are taxable using the graduated tax schedule. This brings us to the end of this class. In today's class, we explain withholding taxes, how overtime and bonus incomes are taxed, and benefits in kind and in cash, as well as quantification of loan benefit. Hope you enjoyed this lesson. Thank you.